My name is Charlie, and on this channel I make videos about building wealth and achieving financial freedom so that you can free up your time to focus on the things that you truly care about. So this is the 11th episode of my Road to Financial Freedom series, and this is where I document the growth of a small portfolio that I started about 10 months ago, which I'm trying to grow using the strategies that I talk about on this channel, like covered call writing and leaps option buying. So I started the account with a $5,000 deposit, and in addition to that, I'm also depositing $100 every single week. So the goal is basically to simulate the portfolio of someone working to achieve financial freedom starting from scratch, and to see how quickly it can actually be done. Now with all of that said, let's see how the portfolio is doing so far. So as of the end of the day on Friday, October 1st, 2021, my portfolio balance is sitting at about $12,662, and that's based on a total deposited amount of $13,350. So it is actually down in value by $688, or about 2.4%. So it's definitely not ideal, and I talked a little bit in the last episode about some of the reasons for this portfolio's underperformance, but in this episode I'll go into a little bit more detail and I'll talk more about my plan going forward. But basically the main story with this portfolio is that if we take a look at all of my unrealized gains and losses, I'm actually at an unrealized loss of about $7,300, which means that since this portfolio is only down in value by about $700, my total realized gain is about $6,600. So in other words, of the trades that I've actually completed in this portfolio, I am significantly up in value. It's just that the stocks that I'm still holding on to have fallen since I bought them, which I'm normally not too worried about because with the solid blue chip companies that I like to trade in my main portfolio, as long as their fundamentals continue to stay solid, I know they're going to recover pretty quickly. But what I found with these smaller, less established companies is that there's no guarantees even with solid fundamentals. So ChargePoint, for example, even though it has massive growth potential over the next few years, it's fallen in value by an average of about 30% from my initial purchase price. And then Corsair, which is another company that ticks all the boxes of a stock that I typically like to trade, has also fallen by about 25% since I initially bought it. And as you probably know, when you're selling covered calls on a stock and it falls in value, it becomes a lot harder to bring in significant premiums. So if we take a look at my premiums tab, we can see that in September 2021, I only brought in about $99 worth of premium, which is about 0.75% as a percentage of my portfolio. And for reference, my goal is between 2 to 6% per month in premiums. And up until this point, I had reached that goal every single month. So if we take a look at my projected income tab, we can see that September was by far my lowest month in terms of premium percentage. And of course, the reason for that is since my stocks have fallen in value, number one, I'm only selling calls at or above my initial purchase price. So at this point, those strikes are pretty far out of the money, which means the premiums are going to be smaller. And I'm also selling calls a bit further out in time to try to lock in bigger premiums. So that means I'm not selling calls as frequently and therefore not collecting premium as frequently. And under normal circumstances, that would be perfectly fine because as long as I don't have to sell anything at a loss and I still like the stocks that I'm holding and selling covered calls on, I know the portfolio is going to do well. But in this case, I'm seeing that with these smaller stocks, although I still really like them fundamentally and for the long term, which I'll get into in a few minutes here, I don't know that I still like them as covered call stocks. Because with the more established blue chip companies that I typically like to trade, it's more of a sure bet that when they release a positive earnings announcement and they continue to grow their revenue over time, that the stock price is going to keep rising. Whereas with these smaller, more recently public companies, they don't have as much institutional investment and the short-term stock activity is more based on sentiment than fundamentals, so there's really no guarantees. Now given that, let's talk about my thoughts on the stocks and what I plan to do with them going forward. And to be clear, I'm still happy with all of my long-term holds. I'm still happy with my leaps option on Nike even though it has fallen in value. And I'm still happy with my poor man's covered call on AMD. Really the only two stocks that I'm referring to here are ChargePoint and Corsair because they are those smaller, less established companies that still have to prove themselves to the market. And because of that, the performance of the stocks is a little bit hard to predict right now. So starting off with ChargePoint, the short of it is that I think there's almost no way that ChargePoint's going to perform poorly over the next 2 to 5 years. With the rate that EV adoption is growing, there's going to be a massive need for EV charging, and currently ChargePoint is the #1 provider of that in the United States. As electric vehicles become a lot more affordable and more legislation is introduced that encourages people to switch over to EVs, I think we're going to be seeing huge exponential growth in this industry over the next few years. And the market just really doesn't understand that, as we we've seen with Tesla and a lot of other EV stocks. So for whatever reason with companies like these, it seems to take massive, overwhelming evidence that these companies are going to be successful before the market even starts to recognize them. But for anyone who's actually paying attention, it's easy to see where the industry is going. I mean, if you just take a look at Tesla, they're selling far more cars than they can even produce. And that number is growing exponentially on a quarter-to-quarter basis as they build out more and more facilities. And as it stands right now, EVs are still quite a bit more expensive than traditional internal combustion vehicles. And as they become significantly cheaper, which they will over the next few years, this industry is going to blow up, and I really don't think that the market is taking that into account. But when it comes to selling covered calls, although it's important to have stocks that we believe in for the long term, we also care about the short term, and that's where this stock is a little bit more uncertain. Like I said, when it comes to EV stocks, it seems to take overwhelming growth and profitability before the market really recognizes it. And I don't think that's going to happen for ChargePoint within at least the next 1 to 2 quarters. But if we do see some sort of positive news around the EV industry over the next few months, I think that'll be a big catalyst for ChargePoint stock. For example, ChargePoint has been making some smaller deals with companies to install charging stations at their locations. So if they make a bigger deal with a more well-known company, or if Congress passes some sort of spending bill to provide funding for EV charging infrastructure, again, I think that'll really be a catalyst for ChargePoint stock. So for that reason, I'm gonna give this stock until about the end of the year before I reevaluate and see what I want to do with it. So that'll let me see one more earnings report. And at that point, if I don't want to continue selling covered calls, I think what I'll do is sell off some of my shares, which I can then write off against my gains for tax purposes. But I will hold on to some as a long-term hold because again, this is one of the companies that I have the strongest conviction in for the long term. And especially at its current price, I think it's just an opportunity that can't be passed up. Now when it comes to Corsair, my plan is pretty similar, so I think I'll give it until the end of the year so I can see one more earnings report and see how the market reacts to it. In the case of this stock, it's still a company that's showing very strong growth, but it has recently IPO'd over the last year or so, and so after that initial offering, it did rise pretty significantly through about January 2021, and ever since then, it's sort of been steadily declining. So I think this is just a case of that initial hype causing the stock price to spike, and now it's kind of leveling out and trying to find its true value. But again, I think if it continues to grow at the rate that it has, it should do very well over the long term. But just like ChargePoint, in the short term, I'm not exactly sure what'll happen, so I do want to see one more earnings report, and in the meantime, I'll just keep selling covered calls against it, and then at the end of the year, I'll be able to decide what I want to do with it. Because again, since I have about $6,600 worth of realized gains, and that'll continue to climb throughout the year as I collect premiums, it wouldn't be a bad thing to realize some of my losses so that I can write those off against my gains for tax purposes. So in hindsight, what I wish I did with these stocks was just held my initial 100 shares of each rather than continuing to buy into them as they dipped. And I even said it at the time that I was going against my own rules by doing that because I don't usually like to buy stocks as they're falling in value. I thought that these stocks might be an exception because they were a little bit more volatile and the price has been more dependent on sentiment rather than actual fundamentals. But I should have known just to stick to my discipline because if I wasn't stuck in over 200 shares of each of these stocks, that would allow me to diversify into a couple others and probably see better performance in this portfolio than I have. Now, moving on to my poor man's covered call on AMD, this is a trade that I'm still perfectly comfortable with. Of course, my leaps option has fallen in value since I bought it, but AMD is a very solid company and I'm still very happy with holding on to it. I think this is another case where the stock got a little bit ahead of itself after the last earnings report, but I'm still confident that AMD will continue to exceed expectations as it has pretty much every quarter for at least the last year or so. So again, this is one that I'm just selling calls a little bit further out in time right now, and I think that after we see the next earnings report, it'll start to recover again in price. But where I did actually go wrong on this poor man's covered call is when AMD stock was rising pretty rapidly, I ended up rolling my calls up, which caused me to miss out on some of that guaranteed premium, and then when AMD pulled back, I really took a hit from that. So that's another thing that I've talked about on this channel, that I don't like to roll out my covered calls when my stocks rise in value. But even I sometimes get greedy and break my discipline, so it just goes to show you that you have to stick to your discipline and don't let your emotions control the trades that you make. If I wouldn't have rolled this call out, I think I would currently be selling calls closer to the 115 or 114 strike price, which would allow me to bring in much better premiums than I currently am now, having to sell calls around the 123 strike price. And of course, on top of that, my leaps option wouldn't be down in value as much as it currently is. But again, AMD is a stock that I still am comfortable with holding, and I am okay in this trade, despite having to sell calls a bit further out than I would like to. Now looking at my leaps options, I'm still just holding that one Nike leaps, which is down in value, but this is another one that I'm still very comfortable with. I was happy with Nike's last earnings report, with revenues being up about 16% year over year. But I think that most of the drop can be attributed, number one, to just the overall trend in the market being downward. And number two, I think investors are concerned with what revenues are going to look like going forward, given the supply chain issues that we're seeing across a lot of industries. But again, for me, I've seen Nike continuously outperform expectations. And with this leaps option expiring pretty far out in time, I feel confident that if I just hold on to it, it'll eventually do pretty well. Now looking at my long-term holds, again, I'm pretty happy with them, and overall they're up about $163.69. So currently Apple, Nike, and MasterCard are the only three that are actually down in value. But again, that's really just due to all of the uncertainty in the market right now, and if we would have looked at them about a week or two ago, they were up in value. So I think that as the market starts to recover, they'll be doing just fine. So overall, of course, I'm not very happy with how this portfolio is performing, especially considering the potential that I know this strategy has. And for reference, my main portfolio is up about 34% over the same time period since I started this portfolio, whereas the market as a whole is up about 18%. So even that has been a bit of a slower year because the tech stocks that I typically like to invest in have actually underperformed the market, but I still certainly can't complain with almost doubling the performance of the market as a whole. But anyways, despite the poor performance of this portfolio so far, in a way I am happy that it's playing out the way that it is, because if you're going to see performance like this, it's best to see it when the portfolio is just starting out. Because really the difference between being down 3% or being up even 20% is only a few $1,000s in a portfolio this size. Whereas if this portfolio was $100,000 or more, that 20% swing would be $20,000. And on top of that, as I always mention, this portfolio is a learning experience for me too, to see how to apply covered calls on a smaller portfolio. But it's nice that I'm forced to keep making videos about this portfolio, talk through my thought process, and we can all sort of learn together and figure out the best way to apply this strategy on a smaller portfolio. So like I've often said, when you're first starting out, the most important thing is just developing a solid plan for saving money and depositing it into your brokerage account on a regular basis. At the beginning, that's really what's going to help to grow your portfolio the fastest. And so again, when your portfolio is small, it's the best time to learn, because even if you make a mistake, in the long term, it's not going to affect your balance that much. So now if you missed my last Road to Financial Freedom video where I talked more about what I think is a better strategy than trying to sell covered calls on smaller stocks, I'd recommend you check that video out in the bottom right corner of the screen. Thanks a lot for watching, and I'll talk to you all in the next one.